G'day, and welcome to another episode of This is Investing. I'm your host, Vince Scully, founder of Life Sherpa Invest, and today we're talking all things gold. Now, I probably don't have to tell you that in 2024 and 2025, gold has delivered a stellar return. It's delivered lots of headlines and even created queues outside the gold bullion shop on Martin Place. But none of this is a particularly good reason to hold it or not hold it. Despite the fact that the gold market capitalization is about a third of the global equities market, few of our major super funds have an allocation. But at Life Sherpa, we've long been investors in gold, treating it as the first port of call when it comes to a defensive allocation. And today I want to dive deep into why gold belongs in your portfolio and why, despite the hype, Bitcoin is not digital gold. That's after this. So, gold is a somewhat divisive asset class, with some studiously avoiding it and others embracing it with gusto. These are the so-called gold bugs. Now, whilst I never call myself a gold bug, we are long-term investors in gold at Life Sherpa. But Warren Buffett said that gold is just about the last thing I'd want to own, while Ray Dalio said that adding gold to your portfolio is both risk-reducing and return-enhancing, and that there is no sensible reason to not hold gold other than you don't know history or you don't know the economics of it. Either way, it has a very special place to play in portfolios for investors who live in commodity countries such as Australia, Canada, and South Australia. And that's not quite the same return you would expect to get as a US investor. And much of that commentary you're going to see on the internet and in investment circles generally is US-centric. So you have to look at this from a non-US perspective, and you have to look at it from a resident of a commodity currency country like Australia. So I think it's worth starting at the beginning with what is gold. Gold has, historically, it's been used as a currency. It's been used as a store of value, and it does a particularly good job as a store of value. And much of this use is by central banks. So most central banks around the world, Australia is an exception to this, that central banks hold vast chunks of gold as a store of value. It's historically been a medium of exchange. We've had gold coins, but it is heavy and it is difficult to break down into smaller units. It's a commodity, so it has some industrial uses, particularly in electronics and in jewellery. As an investment, it's a little bit more complex. Those who, like Warren, don't like gold, they see it as, well, it doesn't have a cash flow, therefore it's not an investment, we can't value it. That's not strictly true, that it is possible to generate leasing revenue. And gold is generally in what they call contango as opposed to backwardation. So contango is where the future price is higher than the spot price in general. And so in theory, you should always be able to sell your gold for delivery tomorrow cheaper than you can buy it today. Most gold funds, and certainly the ones that are available in Australia, don't generate revenue from those. But those income-generating opportunities do flow into the value of gold. More importantly, it's got a role as insurance, that it helps protect portfolios from declines in other asset classes. It's also an inflation hedge. So over time, gold has grown in real terms, at least since it was removed from the gold standard in 1971. Before that, most currencies were pegged to the US dollar, so the price of gold was largely an arbitrary number selected by the value of that hedge. But $100 in gold in 1971 would be worth $3,370 today, at the beginning of 2025, or just shy of $1,100 adjusted for inflation. So that's in US dollars, of course. And so that is a very solid inflation hedge. The correlation with short-term inflation, and particularly short-term expected inflation, is much less clear. But the value here is its hedge against unexpected inflation, which it's extraordinarily good at. But this much is clear. Gold is a diversifier. So if you go back to your portfolio construction theory, Harry Markowitz, who won the 1990 Nobel Prize in Economics, showed how investors can achieve the best return potential by combining assets that behave differently. That is, they have imperfect correlation and ideally low to negative correlation. Gold has a very low or negative correlation with most other asset classes. Few assets share this quality, and it means that gold can reduce the risk in your portfolio, all other things being equal. So gold is an insurance policy. It's historically been a particularly effective way to preserve the real value of your wealth, since it acts as an insurance policy against currency devaluation. Gold's treated in the market as a safe haven. So when markets get rocky, when economies stumble, investors flock to gold. And that helps cushion the impact of share market falls, especially when you get political uncertainty, as we've sort of seen through 2025. And we like it for its defensive characteristics, but growth-like returns. So over that post-1971 period, the S&P 500 has delivered about 12%. Gold's delivered about 8%. Bonds have delivered 4 to 5 probably. So that's really important. So now I'd like to turn and look at how this has actually worked out in practice over the past for investors. And for those of you watching the radio with pictures on YouTube, I've got a graph here which shows that when global markets fall, the US dollar rises. And so since the GFC, every major downturn, apart from 2025, which obviously came from largely US political uncertainty, every downturn in the S&P 500 has been accompanied by a rise in the US dollar against other currencies. So if you look at 2010 as we came out of the GFC, 2011, 2018, 2020. So if you look at the COVID, we had that early period in 2020 when global share markets fell very strongly. The US dollar rose very strongly. Similarly in 2018 and 2022. So, but it didn't happen in 2025 when much of the conniptions in the stock markets was driven by geopolitical risks in the US. And so people shunned growth assets and they also shunned the US dollar. So that's the only time in the post-GFC world where this correlation hasn't happened. And historically it's happened in the vast bulk of cases. So for an Australian investor, holding US dollar assets is generally a good hedge, and holding gold gives you a double benefit. And that's really important for Australian investors, because usually when the US dollar rises, the Australian dollar falls more, along with the rand and the Canadian dollar, falls further than most other currencies because they are commodity currencies. So economic downturn, lower demand for commodities, people move to the US dollar. Australian dollar falls twice as hard. And this is why you shouldn't currency hedge your overseas share investments. And gold also rises when global markets fall. And it's priced in US dollars, which gives a double bonus for Australian share investors. And it does it better than bonds. So let's have a look at the bar graph that shows bonds against gold. And for those watching on the radio with pictures, we can see that in every year since 2015, or in most years since 2015, bonds and golds have moved in the same direction, but gold has generally moved more strongly. There are 3 exceptions to that. 2015, this was a very turbulent year as we came out of the recovery from the GFC. So the US started to raise rates and turn off the flow of money tap that got us out of the GFC. And this led to the US dollar rising. China slowed and the central bank sold gold. Oil price collapses, Greece close to default, Switzerland breaks with the euro peg, and bond investors flock back after a long period of zero to negative rates. So that showed 2015 bonds up, gold down. Unusual. 2021 and 2022, both bonds and equities declined, leading to general negative returns through 22. And so this shows us that both bonds and equities both bonds and gold help smooth out your equity returns, but gold generally does a better job of it, especially for those of us living in commodity currencies. So after the break, we're going to come back and look at how it's also helped smooth out your returns when it comes to equities.
This Is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
And we're back. So in each of the downturns in equity markets since the GFC, gold has delivered protection for Australian investors. So if we start with the GFC, so if we got the 2008 graph, so from the share market peaked in November 2007 and gradually slid to a bottom in sort of mid-2009. And through that period, gold delivered positive returns. In fact, it was up 60% by the time the stock market fell. And so over the period to the end of 2010, gold was up 50%, 45%, and the ASX 200 was down 17 or 15. So, big smoothing effect. Now, clearly, you wouldn't have had a 50-50 portfolio, but definitely a lot of smoothing happening. Moving on now to 2018, which was the next downturn after that. So 2018 was an unusual year. So in February, Wall Street crumbled spectacularly after unexpectedly strong wage data, stoking fears of rapidly rising interest rates and a so-called bond volcano, that's a volcano of bonds, erupted. The ASX, along with every other major global equities, was also down, and in fact the ASX 200 gave up $90 billion in just 2 days. Markets did rebound very quickly, but it did lead us into what the Guardian called the year of living nervously. It certainly was a rough year. And this is probably one of the roughest years in, I guess, living memory for many young investors. But the end result for the year actually wasn't too bad. It was a very minor downturn for a well-balanced portfolio. Moving on to COVID, which probably was a tough year for many of us, although frankly most of us were far more concerned about staying alive than what our portfolios were doing. But both bonds and equities declined here. Although the year ended square, so the calendar year 2020 ended up pretty well square to slightly up. So ASX peaked in February and declined rapidly to early April when we saw the first lockdowns happening. The market slowly recovered, so by the time you get to the end of the year, it's all looking pretty good. And most super funds with a bit of US and other coverage would have come pretty close to being square again by at least the financial year to June 30 was marginally up for most people. Obviously not relative to February 2020, but for the financial year to June 30 and for the calendar year to December, the end result was positive. 2022, on the other hand, was a much more volatile year. And here, both bonds and equities delivered double-digit negative returns in the first 4 months. We hit 40-year highs in inflation. Russia invades Ukraine. Oil prices spike. Geopolitical fears. It was a very bad year, but by the end of it, it was still down for the year, but gold again provided a very strong negative correlation here. Over the total year, the net difference was small at about 5%, but when you look at the February-March volatility, you had 7-8% declines in the ASX 200 and 10 or more % growth in gold. So these are really important negative correlations. And so through all of this period, gold delivered its promise of smoothing out the ride. And looking at 2025, whilst it's not quite complete at the time of recording this, we had that big dip in April when global markets fell on the Trump tariff tantrum. The US dollar didn't help us here because it fell, but gold did. So, we did get that positive return from gold. So this is the other aspect of it. This is gold as a shelter from geopolitical uncertainty. And although it wasn't also accompanied by the US bond, it certainly delivered very strongly on that. And we've seen very rapid rises in the gold market. So through all of that 15-year period, gold delivered its promise of smoothing out the ride. Which brings us on to the 21st century equivalent of, arguably, the 21st century equivalent of gold, and that's Bitcoin. And we've seen, or crypto generally, but Bitcoin specifically, we see a lot of people in the crypto space spruiking Bitcoin as digital gold. So I just want to test that theory a little bit and see how it goes. So the crypto bros like to spruik crypto as digital gold. And on the surface, this pitch looks pretty convincing. But once you look at the detail behind it, it starts to lose its convincingness. They do share similar characteristics. Both have scarcity. Gold's difficult to mine and in limited supply. Bitcoin has programmatically enforced finite maximum supply of 21 million coins. Both are said to prevent inflationary pressures resulting from central banks' ability to print fiat currency in unlimited amounts. That's mostly people not understanding modern monetary theory, but they are very similar in that space. Both are durable and fungible, so both assets are non-consumable and fungible, and any unit can be exchanged for any other without losing any value. Both have an element of decentralization, so neither asset is controlled by a central authority such as a government or a bank, although central banks do own around a fifth of the gold supply and can change the supply equation by moving that. Store of value, gold has established itself as a reliable store of value over time. Proponents of Bitcoin believe it can perform this role in the 21st century and offer a long-term hedge against devaluation of paper money. I think the jury's still out on that story. Portability and verifiability, both offer the ability to move around. Most gold trades are traded without the physical bar moving from the warehouse it sits in. Bitcoin, I think, is ahead of gold in this area. Value Bitcoin can be moved practically instantaneously around the world extraordinarily cheaply. Gold can also be transacted fairly cheaply within a market, but moving gold from the UK to the USA, which really became important earlier this year, where the threat of imposition of tariffs led to a dislocation in price between the New York price and the London price. And so people were buying gold in London for delivery and selling it in New York. That involves recasting the bars into different sizes. So to buy gold in London and sell it in New York, you've got to ship it to Switzerland and recast it into a different size bar. So that comes at a cost, and that sort of provides a bit of a floor on the difference in price you can see between the two markets. That's not a problem for Bitcoin. So, but I think that's really where the similarities end. Correlation, as we've been discussing, is sort of pretty critical to this whole defensive story. So if cryptocurrencies really were digital gold, then the correlation between cryptocurrencies and gold should be reasonably high. This is not the case. There is a close to zero correlation between the two. This might be a good reason to hold both, but Bitcoin is far more closely correlated with risk assets such as equities. There's about a 70% correlation between the S&P 500 and Bitcoin. And that's largely driven because liquidity is a major driver of crypto values. So excess liquidity, cheap, easy money, is typically a driving factor for speculation and bubbles. And that's because, it's hard to speculate when financial conditions are tight and lending is constrained and the economy is contracting. But risk-taking increases as financial conditions ease, lending expands, and overall economic liquidity grows. Whereas gold thrives in the first of those, that constrained markets, low liquidity, gold is great. And there is a distinctly different behavior between liquidity driving the price of crypto, uncertainty driving the price of gold. And those two do not go hand in hand. So none of those are reasons to embrace or avoid crypto. It's just to illustrate that the claim that Bitcoin is digital gold is unsustainable and to a large part nonsensical. So, no, Bitcoin is not digital gold. They may very well both have a place in your portfolio, but they're not the same thing at all. So that brings us on to the topic of how you should be buying gold. And until 2007, most people either bought physical gold bullion as bars or coins. These come with storage and minting costs, and they're generally more expensive to trade than paper gold. But from an individual perspective, we really couldn't do that until 2007. The other way we got exposure to gold before that was by buying shares in gold mining companies. It's an imperfect hedge, but a gold mine is effectively a call option on gold at the cost of mining. So if it costs you $100 or $400 to mine an ounce of gold, then you've effectively got the ability to create as much gold as you want at $400. So if the price of gold is more than $400, you can make money. However, gold mining stocks tend to have a reasonably high correlation with equities generally. And so whilst that might be a good investment, it doesn't quite behave the same way as physical gold as a hedge. And the significance of 2007 is that was when the first gold ETF, although technically it's an exchange-traded product, it's not actually an ETF. It's more akin to a preference share, but it's a piece of paper that's exchangeable for physical gold. So the gold ETF was launched in 2007, and that gives a very low-cost, convenient way of holding physical gold without the storage problems, without the insurance problems of keeping it home, and without the cost of trading it. So when we look at the ETF option for buying physical gold, which is our preferred method of accessing the sector, there are 5 products you can buy on the ASX that track physical gold and are unhedged from a currency perspective. The OG and the biggest by far is the Global X Physical Gold ETF. It's got a ticker of GOLD, and that's $6 billion. So it's about the 6th or 7th biggest ETF. It's a beautiful thing. They recently launched a slightly cheaper version of it, which is actually a true ETF rather than an ETP. It's slowly gaining traction. There's also an iShares one called GLDN, but it's only got 350 million in it. The other big one is PM Gold, issued by the Perth Mint, again backed by physical gold. That's at 2.3 billion and significantly cheaper. And then a smaller NUGG, the VanEck Gold Bullion. So gold is the biggest, has the lowest spread and the highest turnover. But it does have the highest MER of all of these. It's still our pick for all of those reasons apart from the fees, that we think the fee is justified based on all of those other things. PM Gold is probably the next biggest. It's issued by the Perth Mint. The Perth Mint is ostensibly backed by the Western Australian government, but it has a pretty patchy compliance record, which makes it a no-go for us. It's about half the size of gold, but has a much lower MER. It's performed marginally better, mostly being the difference in the MER, but its spread is twice as big, and it has a third of the turnover. So the higher MER of gold, we think, is justified. Compliance is a hygiene issue for us. problems with compliance is always a red flag. GXLD, the Global X, have launched a sister fund to gold. It's structured as an ETF rather than the older ETP technology. That difference is largely academic for most investors. It's got a lower MER. It's performed almost identically despite the lower MER since it was launched in May 2024. It's too small for us to take it seriously right now. So this is a watch and wait while it gathers AUM. So it's potentially a game changer. It's still physically exchangeable for gold. It's still allocated gold stored in London, and it's backed by a fairly major ETF issuer. All of the others are still too small in our book. The only two serious players today are PM Gold and Gold, and we don't like the compliance record of the Perth Mint. There are a couple of hedged products, and as I said, we don't believe that if you're investing in gold, you should be hedging your currency. And that's the BetaShares QAU and GHLD, which is a Global X hedged version of gold, neither of which fulfill the thing that you're looking for. So, in summary, gold is for protection without sacrificing much by the way of returns. So it's our first port of call when it comes to a defensive allocation. So when you step down from 100% growth allocation, which is highly unlikely to be suitable for many investors, the first layer of defensive protection is gold. Big impact on portfolio volatility, very low impact on returns. And you need less of it to give you that benefit than you do of bonds. So for that reason, it's our first port of call in defensive. And after that, we'd move on to local currency bonds and eventually to global bonds as you got more and more down the conservative space. We think it's a really important part of any diversified portfolio for an investor that lives in a commodity currency. So if you're Canadian, South African or Australian and you're listening to this, you need to be aware of gold, how it works and why it delivers the benefits to your portfolio. And that's it for today. So till next time, I'm Vince Scully. Bye for now. This is Investing.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds financial services licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.